Why gold still controls global finance. For thousands of years, gold has survived almost every economic system humanity ever created. Empires collapsed, currencies disappeared, wars destroyed economies, governments changed, but gold remained valuable through all of it. Even in today's digital world filled with AI, crypto, and online banking, gold still plays a massive role in global finance. Central banks continue buying gold. Investors rush toward gold during uncertainty, and entire countries store enormous gold reserves for economic protection. So why does humanity still trust gold after thousands of years? Why does gold become more important during fear and crisis? And why do some investors believe gold could become even more important in the future? In this video, we'll break gold down completely. How gold became valuable, why governments store it, how inflation affects gold prices, why gold and the dollar compete, and why gold still influences the global financial system today. How gold became money. Long before modern banking systems existed, gold already had value. Ancient civilizations used gold because it was rare, durable, difficult to fake, and easy to divide into smaller amounts. Unlike paper money, gold could not simply be created endlessly. That rarity made people trust it. Over time, gold became one of the first universal forms of money. Empires traded using gold, kings stored gold as wealth, and nations measured economic power through gold reserves. Eventually, many countries created something called the gold standard. Under the gold standard, paper money was directly connected to physical gold reserves. This meant governments could not print unlimited money freely. The system created financial discipline, but as economies became larger and more complex, many governments eventually moved away from the gold standard. Even so, gold never lost its reputation as a store of value. Why gold still has value? One of the biggest questions people ask is, why is gold still valuable? Gold has value because humans collectively trust it, but unlike many other assets, gold also has several unique characteristics. First, gold is limited. There is only a certain amount of gold available on Earth. Mining new gold is expensive and difficult. Second, gold cannot easily be destroyed. It survives through time without rusting or decaying. Third, gold became psychologically connected to wealth and security throughout history. For thousands of years, people viewed gold as protection during unstable times, and that psychological trust still exists today. Gold also has industrial and technological uses. It's used in electronics, medical equipment, aerospace technology, and high-end manufacturing. But most of gold's financial value comes from trust and scarcity.
Why investors buy gold? Most investors do not buy gold, expecting explosive short-term growth like technology stocks or crypto. Instead, many investors buy gold for protection. Gold is often called a safe haven asset. This means investors usually move money into gold during uncertainty. For example, economic crises, wars, inflation, banking instability, political uncertainty. During periods of fear, investors often want assets they believe are safer and more stable. Gold has historically benefited during those moments. Some investors also buy gold as insurance against inflation. When governments print large amounts of money, paper currencies may lose purchasing power over time. Gold, however, cannot simply be printed. This is why gold often becomes more attractive during inflationary periods. The relationship between gold and inflation. Inflation means prices rise over time. As inflation increases, money buys fewer goods and services. For example, years ago, a small amount of money could buy much more than today. This loss of purchasing power worries investors. And historically, gold often performed well during inflation fears. Why? Because many investors view gold as a hedge against currency weakness. If people lose confidence in paper money, they may move wealth into gold. This is one reason gold prices often rise during periods of high inflation, money printing, economic uncertainty. However, gold does not always move perfectly with inflation. Interest rates also matter heavily. How interest rates affect gold. Gold does not produce income. Unlike stocks, gold does not pay dividends. Unlike bonds, gold does not generate interest. Because of this, higher interest rates can sometimes hurt gold prices. Why? Because investors may prefer assets that generate income. When central banks raise interest rates, government bonds and savings accounts may become more attractive. This can reduce demand for gold temporarily. But during periods of economic fear, gold can still rise even when rates are high. This creates a complex relationship between gold, inflation, and central bank policy. And this is why investors closely watch the Federal Reserve. Why central banks buy gold. One of the most important facts about gold is this: governments themselves still buy it. Central banks around the world store enormous amounts of gold reserves. Countries including the United States, China, Russia, India, all hold major gold reserves. Why? Because gold provides financial stability. Gold is considered a reserve asset. If global financial systems become unstable, gold can help support confidence in national reserves. Some countries also buy gold to reduce dependence on the US dollar. This became increasingly important as geopolitical tensions increased globally. In recent years, many central banks actually increased gold purchases significantly. Gold versus the US dollar. Gold and the US dollar have an interesting relationship. The dollar became the world's reserve currency after World War II. Most global trade today still happens using dollars. Because of this, the dollar holds enormous global power. But gold often acts as an alternative store of value. When confidence in the dollar weakens, gold sometimes becomes stronger. And when the dollar becomes very strong, gold prices can struggle. This relationship is constantly watched by investors worldwide. Some analysts believe gold protects against long-term currency devaluation. Others believe the dollar will remain dominant globally for decades. This debate continues shaping financial markets today. Gold during financial crises. Gold often becomes extremely important during economic panic. During financial crises, investors usually seek stability. This happened during the 2008 financial crisis. COVID economic uncertainty, inflation spikes, banking fears. When markets become unstable, gold often attracts attention as a defensive asset. However, gold is not always perfectly safe. Gold prices can still experience volatility. But historically, gold maintained long-term trust better than many currencies and financial systems. This long history created gold's reputation as financial protection. Physical gold versus digital gold. Today, some investors compare Bitcoin to gold. Bitcoin is often called digital gold. Why? Because Bitcoin also has limited supply and scarcity. Younger investors especially became interested in digital assets instead of physical metals. But traditional investors still prefer gold because it's physical, historically trusted, globally recognized, and less volatile than crypto. This created a new debate in finance. Will digital assets eventually replace gold? Or will gold remain the ultimate store of value? Right now, both assets continue attracting investors for different reasons. Risks of investing in gold. Despite its reputation, gold still carries risks. Gold prices can fluctuate. And during strong stock market growth, gold may underperform compared to technology or growth investments. Gold also does not create business earnings or innovation like companies do. This is why many investors use gold mainly for diversification and protection, not necessarily for explosive growth. Professional investors usually balance gold alongside these stocks, bonds, real estate, and other assets. Final thoughts. Gold survived kingdoms, wars, inflation, banking crises, and economic collapses. For thousands of years, humanity continued trusting gold during uncertainty. And even in a modern world dominated by AI, technology, and digital finance, gold still remains deeply connected to the global economy. Some investors believe gold's role will grow as debt and inflation continue increasing. Others believe newer digital assets may eventually compete with gold more aggressively.